Hello, scholars. This is me, Dr. Joseph A.G.K. Oji. Tonight, the topic of our lecture is how to use the discounted cash flow method to estimate the cost of common equity. Before I begin, I want to make sure that you can see my screen very clearly, and then let's start. Now, again, the topic is to show you how to use the discounted cash flow methods to estimate the cost of common equity. The formula to use, you can see it in the screen here. RS equals D1, where D1 represents the dividend expected to be paid at the end of year one. So D1 divided by PO plus the expected G. PO represents the market price of the stock or the stock's intrinsic value, and expected G is the expected growth rate in dividend. Excuse me. So let's see how we can estimate all these inputs. The dividend that is D1, the expected dividend, and PO, which is the market price of the stock, and then of course the expected growth rate of dividends. How do we get this input that we can use? How do we get this input that we use in the formula to find the cost of common equity? How do we do that? So I'm going to show you in a minute. Usually it is easier to get some of the inputs, but not others. For example, as a matter of fact, the three inputs that are needed, like I explained in the last slide, the three main inputs we need are actually the current stock price, which will be the proxy for the stock, stock price, the current dividend, and then the marginal investors' expected growth rate. Now, the price of the stock and dividend can be easily, we can easily estimate that for the particular company, because we can go to, they are actually in the public domain. Let me show you this. Let's say that this is, you can go to Yahoo Finance, for example. If it's a company, let's say that it's a company that pays dividends, you can get it from there. Let me see. Let me try ExxonMobil, for example. ExxonMobil Corporation. You can see right here. So we can get the price or the stock price from here. It's $107 per share. $107.60 per share. So that's very easy to get. That gives us we can use that as the proxy for the stock price. Now, for the current dividends, if the company pays dividends, we can get it from here, from the Yahoo Finance as well. For this ExxonMobil Corporation, we can look at the historical data for that company. That is the historical stock price. This is the daily price. So daily is more noisy. So I'm going to make it monthly, and I can now apply it. So you can see the dividend they paid in August of 2020. They paid 91 cents per share, and the dividend they paid is 91 cents per share as well in May of 2023, and so on and so forth. And if it's another company, let's say Apple or any other company that pays dividend, let's say try Apple. You know what? You might even try Amazon. So let's see AMZ, right? Amazon is AMZ. Excuse me. AMZ. The trading symbol is AMZN. Okay, we'll try for Amazon. This is the stock price here. You can see the stock price. That gives us the stock price right away. And for the dividend, you can try the historical data, and again, make it not daily data, make it monthly. You can see if they paid any dividend. And they didn't pay a dividend, so that the dividend growth rate is we can it's zero. They didn't pay any dividend this year. Another company might help. Company like you can try Walmart. Let me see. Apple Corporation, Apple Incorporated. Of course, you see the stock price here in the screen. And then let's see if they pay dividends. You can try the historical data, make it monthly, okay, and apply it. Apple paid a dividend of 24 cents per share. You can see that in August of 2023, and in November of 2022, they paid $23 per 23 cents per share. So what I'm trying to say here is that the first two inputs that we need, we can estimate it. We can get it easily, the current price and the current dividends. But the marginal growth, marginal investor expected growth rate of the dividends, we might not be able to get it because it's not in the public domain for each company. But we can estimate it by ourselves by following this approach that I'm about to explain. Say the expected growth rate in the dividends. You can use the historical growth rate of the dividend or even the earnings. Now, if the earnings and dividend growth rates have been relatively stable in the past, and if investors expect this to continue, then the past growth rate may be used as the estimate of the growth rate of dividends. So that means, for example, what we have before the Apple, you see the historical dividend that they paid. You can use this to calculate the growth rate of dividend by ourselves. We can check this out for several years. For example, I can increase this to 5 years and then apply it, okay, monthly. You can see the different dividend they paid for different years. Even in 2020, you can see dividend about approximately 21 cents. You can see in 2019, they paid 19.19, that's basically 19 cents per share. So you can use that to estimate the growth rate, our G, or expected G, which is the growth rate. Then another method, we can say, okay, we can try using the retention growth rate, where we need two things, payout ratio and the retention ratio. So the payout ratio simply means the percent of net income that the firm pays out in dividends, you know. Then the retention ratio simply means 1 minus the payout ratio. When you factor these two together, we can calculate the expected growth rate in dividend by using this formula, which is G equals to return on equity times the retention ratio. So another way you can determine G is to use the analyst forecast. If you listen to CNBC, which is a business channel, analyst makes a lot of forecasts about growth rates of dividend for some specific companies. You can also use that. Or you can subscribe to there's one particular website, they call it Value Line. You can subscribe to them and get that information. Value Line provides and publishes earnings growth rates, estimate of G, which is a dividend growth rate for about 1,700 companies. So if you subscribe with them, you can get that information as well. Anyway, I think you get the point. Now, assuming that we have those information, which means that we have the current stock price, the current dividends, and the marginal investors' expected growth rate. So how do we calculate the cost of common equity? Let's try an example here. It says here, how do we calculate it using the discounted cash flow methods? You know, let's do this example. It says here, the question says, Serenity reports common stock is currently trading at $36 per share. The stock is expected to pay a dividend of $3 per share at the end of the year. So, and the dividend is expected to grow at a constant rate of 5% a year. What is its cost of equity? So we are giving the stock price as $36 per share, and we are giving the amount of dividend they pay at the end of year one, which is $3 per share. And the dividend is expected to grow at a constant rate of 5%. So we have the three inputs. So what is the cost of common equity? So let me write this down, and then we can put it in Excel and get the answer right away. D1 is $3 per share. The price of the stock is $36 per share. And the expected G is 5%. So let's go and put it in. And as I do, I also did the work here as well. So we can we go and put it into the in Excel, so we can get it, so that we can get the information. We have all the information here. Remember, this is for Serenity Resorts, and that the stock is trading at $36 per share, and that the dividend is $3 per share, which is a good dividend, by the way. And of course, the growth rate is 5%. So let's go and put them in Excel and then get our answer. So we have the price is $36 per share, and the dividend at the end of the year one is $3. The expected G is 5%, which is 0.05. So that the cost of the equity is going to be, you can see the formula here, ROS, cost of which presents, the ROS here represents the cost of common equity. This is D1 PO, D1 for the dividend, and the PO is for the stock price, but expected growth rate. Equal is, okay, dividend of D1. Okay, let me put it in parentheses, okay. D1 divided by stock price, PO, okay, plus the expected G of 5%. Then when you press the enter key, that'll give you the cost of equity. So you can now change this to percent by right-clicking it and then choosing format cell and then choose percentage. Okay. So that is the cost of equity using the discounted cash flow approach. Guys, I hope you enjoyed this lecture. And then what does this let me see. Okay, let's see this because I did this here as well. Yep. So that the cost of equity here is 13.33%. So when you please when you get a chance, subscribe to my channel so that you get notified each time I have lecture like this. Thank you for listening and have a good day. Bye-bye.